Stovall, Chief Investment Strategist, CFRA Research, joins us now. Sam, it's great to have you on. I'd love for you to help contextualize this just in terms of the tactical moment we are in. There's some signs yesterday, overnight Sunday into yesterday, we might have gotten a really big selling crescendo, massive volumes, massive number of new lows. And then today, we have a very, very broad snapback rally. These happen in these highly torqued markets. But where does that bring us in your view?
Hey, Michael, good to talk to you again. Well, I think we really did see, as you said, that crescendo of selling that took place last week and in the beginning of trading activity yesterday, especially the range, the high and the low yesterday, does basically indicate that we're probably close to at least a near-term bottom. I think we probably have to go up to about the 5,400 level on the S&P, which would represent the September retest of 2024. So now that becomes resistance. But I think overall right now investors are anticipating that negotiations are taking place behind the scenes and that there will be some sort of concessions from our trading partners.
The range of possibilities when we get one of these very, very steep declines, 15+%, we got intraday below the 20% line, whatever we're going to call it, there's the possibility, and the hopeful one, is that this is sort of a 1998 or a 2011 where the broader trend is fine, we don't have a recession right ahead of us, and it's much more about kind of a financial market dislocation or a shock, and we can move on from there. And then you have, recession related, and a lot of the markets are trying to maneuver in a direction that says maybe we have to raise our odds of recession. How do those things play out? What would you be looking for to have us know which one we're in for?
Well, I think you're right that the odds of recession have risen. Ours is now at 40%. We contract Action Economics for our economic projections. And speaking with Mike England this morning, basically are looking at the fact that the NBER, the final arbiter of recessions, would probably not say that it started in the first quarter of 2025 because there was an awful lot of purchases that took place in Q1 to try to get ahead of the Liberation Day or in early April. So Q1 GDP probably will not end up being negative, and that we probably might see some softness in Q2. But the NBER would probably look at the old Arthur Okun adage of 2 successive quarters of GDP decline equal a recession. So they probably wouldn't be indicating such until the second or third quarter of this year. So the possibility of recession is out there. But when people started asking me, how far would we have to fall to get to the median trailing 12-month gap PE ahead of recession since World War II, that indicated to me that they were looking for worst-case scenarios, which I thought was a sign of extreme lack of confidence.
No, there's no doubt about it that the mood has changed and therefore positioning and sentiment. But, just for our own sake, where would we have to fall to? What is that median PE that we would typically see at that moment?
Well, it would be about 16.5, which would be a 45% decline from the February 19th high, which certainly would put us into the range of the 1973 to 75 bear market, 2000 to 2002 bear market. So those would be what I call mega meltdowns, which typically take 4 to 5 years to get back to break even.
Right. Yeah. All right. So we know what we don't prefer to see, but appreciate you laying out the spectrum for us, Sam. Thank you.
My pleasure.